Here this morning with Shane Brunette. Back again, Shane. Thank you for coming along. Today is a special tax-heavy edition. Tax has been in the news a lot lately. We've had a budget that's come out. It's not gone well for the government, but it has implications for everyone. And on top of all that, now we have a lot of other stuff that's probably changing your business. The use of AI, maybe. We're going to delve into a bit of that as well.
Excited to be here. Thanks for having me again.
Okay. All right. We've got some questions for you. They've been thoroughly prepared this time instead of a general chat because the people want to know tax.
That's it.
All right. Let's just jump into it. So first of all, let's start with your origin story, Shane. I know we've been through this in the previous podcast, but let's start there. And let's start with, what was the problem that you were specifically trying to deal with by starting Crypto Tax Calculator as it was then called?
Yeah. So I had my own personal tax pain, I suppose. I'm an engineer by trade. Was experimenting a lot with different DeFi protocols and things like this back in 2017. So a long time ago, well before Uniswap or anything like that. And got myself in a bit of a pickle when it came to trying to actually work out my taxes and getting the records all correct. And being the engineer that I was, I thought it would just be, a very optimistic point of view, I suppose, at the time, but just a couple of days to get it sorted out. And, spent months building out this system. Eventually launched it on Reddit because I figured I wasn't the only person having problems in this space. And, caught wind from there. Ended up, was still here 8 years later, a team of just under 50 people working on it, day in, day out. It's expanded beyond just crypto tax for retail now. But, this idea of having all your records in the one place, neatly ordered that you can easily hand over to your accountant, that's the core essence of Summ. And, it's actually a really big problem all over the world as well. It's not just unique to Australia, obviously. Yeah.
You recently rebranded from Crypto Tax Calculator to Summ. I see some new merch.
That's it. Yeah. A couple of reasons for that.
Yeah.
I think, Summ kind of sums up what we're about, like getting everything into the one platform and being able to count on the numbers. I think, as the market's matured, I think it's kind of interesting how crypto's seen as now yet another asset. Mm-hmm. There's more people investing in crypto, as part of their portfolio, and rather than, historically it might have been, I only am a crypto investor. I'm quite ideological about that. Now it's just, there is still that cohort of users, but it's much more distributed. And so, it's just about being able to not only have your crypto there now, it's like, it could be a lot more than that. So it gives a lot of an expandable brand name. The other thing is just, we started off back in 2017 calling ourselves Crypto Tax Calculator. And at the time, no one else was really saying that. But now everyone has a Crypto Tax Calculator. So it's like, how do you make yourself recognizable in the market was another core component.
Gotcha. So since you started 2017, what has been the hardest moment of building the business and what got you through it?
Yeah, the hardest thing, I think the seasonal nature of crypto is an ongoing challenge. There's a lot of ups and downs, and that makes predictability in the business hard, especially being a startup. So that's definitely the biggest challenge, is having conviction through the market cycles. I think we're seeing that again, obviously, right now. The way I see it is like fundamentally crypto is just a technology. Like it's asset ownership through cryptography. Mm-hmm. And, if you take it that way, we are actually seeing crypto ripping. It's just not reflected in the asset prices. Mm-hmm. But we've got more and more real use cases of crypto, like stable coins are increasingly popular. You've got platforms like Hyperliquid, which like people are using despite it being crypto. You've got markets like Calcium, Polymarket. Like there's a lot of, crypto's kind of powering the platform, but in quite a few circumstances now, you don't even realize that it is crypto. It's So I think in that regard, it's been very successful. I mean, obviously, there's a lot of speculation and then draw down on that through these peaks and troughs. And that's where we're going through at the moment. But there's still this fundamental of like, technology, there's no stopping it.
It's an interesting point. I'm getting a bit off topic here, but the idea... most people, when they think of crypto, they think of people buying and selling Bitcoin or Dogecoin or something like that.
Yeah.
It's funny you mentioned the examples of Kalshi and Polymarkets and Hyperliquid of being examples where people are interacting it, and the crypto is what's the word? It's just part of the process. It's not the actual product being bought and sold.
Yeah.
Which is very different. How does that fit into, I guess, the work you're doing with people that, you know, it's like the use of the crypto is incidental to what they're actually trying to trade.
Yeah.
How does that impact on the stuff that you guys are doing?
Yeah, well, I think it makes what we do even more important, because you get somebody, for example, using Hyperliquid. The last thing they want to do is try to work out some really weird quirks with their bookkeeping and accounting. They're just kind of expecting the same reporting that they might get from a traditional broker platform. It's like, just tell me what I made, tell me what my tax is. Like, I want something that I can give to my accountant. Like, there's very little patience for the problem, I suppose. And so, and for any player in the space building these types of platforms, like, you know, tax is something that they don't really want to think about. Like, it's incidental to what they're building. So we come along, we're like the trusted third party who can help solve this problem, which is really a post-sales problem of like, hey, I've done all this activity, I need to hand it off to my accountant at the end of the day, and it lifts customer satisfaction across the board. It's just this pain, right? It's that's really important to us. Is just, it shouldn't be that painful. Like, the fact that this technology is there and available to lift, like, you know, create massive efficiency gains in finance, which is typically like the whole thing about it is like, oh, finance has been, you know, a middle maker taking an outlandish share of the value proposition, whereas the technology compresses that. But part of the blocker is the record keeping, etc. And it shouldn't really be that hard. And, you know, to make an successful adoption of that technology, you need to get rid of that blocker.
Given that your background is you're an engineer before you're an accountant.
Yeah, I'm definitely not an accountant.
Do you think that changes your perspective on things like crypto and how you go about its role in the portfolio and the services you're trying to provide, but also maybe, you know, AI, how that's going to impact your business as well?
For sure, yeah. I got into crypto because I was trying to build something with crypto, right? Like, versus I wasn't necessarily hell bent on a particular thesis. I was actually just building with it, and then I could see its advantages compared to what else was out there. So it's very like engineering wedge into the space, I suppose. I think being a benefit of an engineer is like, you know, typically what we do is, regardless of the industry, you go in and you work with subject matter experts and try to translate what's in their head into code, or increasingly with AI, just feed it straight into the AI to figure it out. But, you know, that's a large part of the problem. And so, like, being able to understand this accounting space, but with a different lens, that's kind of beneficial, and you can kind of make it more accessible to the everyday user now, instead of just talking in accountant jargon. That's a big part. But yeah, with AI coming along, my background before getting into crypto engineering, I suppose, was I did a master's of AI, and during that I started speculating in crypto. That's how it kind of worked out. But that was like almost 10 years ago, so like 10 years too early, I suppose, with the AI degree. Now that we're seeing AI come along, like the way that it's transforming the business, just from the ability to you know, the speed in output is just incredible. And I really think there's something there in terms of like, you know, LLMs and the natural language interface, and how you could put that onto what otherwise would be a really confusing experience. Like with accounting, you can make it much more accessible. and kind of present that in real, like the interface in a way that the person can naturally get from A to B, kind of like if they were, talking to a bookkeeper themselves. But if you think about it, like people only use our platform typically to generate a tax report. Like oftentimes that might just be once a year. And so you don't really want to spend a lot of time learning a UI that you're only going to use once a year. So by having this natural language interface, people can kind of get much more familiar with it straight away. It's just a lot more natural.
So you AI has been integrated into some platform then?
Yes, yeah, we've been working a lot on this space. Like there's a challenge between, accessibility and what AI does with that, and also, trust. Like, can you trust the results? And there's this real balance to be had. But yeah, we've been spending a lot of time on the AI integrations, yeah.
Gotcha. I know you're not an accountant. I know your background is engineering, we've just discussed, but I've got some tax questions.
Yes.
Is this going to be out of line or?
Oh, no, always keen for this. I mean, not tax advice. I'm just an engineer, but I can translate some things in everyday language with some caveats. But
Okay. Well, I've got some questions from the crowd then.
Yes.
I'll smash through them. A lot of people assume that the ATO won't chase crypto activity from 3 to 5 years ago, especially past this 7-year mark.
Yeah.
How accurate is that, and how far back can the ATO actually reach?
Yeah, so the ATO has been spending a lot of time, along with 57 other countries around the world, on this new regulation called what they call CARF, C-A-R-F, not like the cow, but CARF. And really what this is a data sharing program, similar to what they have in equities. They've had it in equities for many years now. When you do a transaction with an offshore account, an offshore exchange, the ATO is going to have a really good chance of finding out that information over the next year or two. And so that's been their main focus at the moment, is this data sharing program. When you think that you've likely have done KYC on a centralized exchange and then, done a bunch of activity and then transferred some of that crypto maybe on-chain, done a bunch more activity, all of this is fully traceable through the KYC, whether you've done that with an Australian domiciled exchange or if you did that offshore, all those records are available or will become available to the ATO. And there's a lot of services out there which are traditionally used for anti-money laundering, which can help you trace all your activity through all of those exchanges as well as the on-chain activity. And I've heard a lot of things like, I can't even make sense of all my activity on-chain. How will the ATO be able to make sense of it? They've got no chance. So, if I can't work it out, they can't work it out. No one's going to know. It's a problem that no one's even going to look at. And, the ATO won't even have the technology. But the thing is, the ATO doesn't really need to work out a lot. You do. As the individual, the way that the tax system's set up, all the burden is on the individual to do a self-assessment or work with a professional to help afford that. But ultimately, it's your responsibility to figure out what the tax is. And if you don't, well, then the ATO has a lot of leeway to make an estimate that's often not in your favour whatsoever. And so, it could be an extremely painful process to get an audit and find out that you've got 3-5 years worth of activity that's completely unreconciled. Some of these brokers are shut down, like FDX went to bunk and you had a bunch of transactions there, all this type of stuff. And really, the burden is on you to prove the correct tax outcome. Otherwise, you'll probably be pushed into a very unfavourable situation. And with technology, this can be done en masse. So the process that the ATO is going through right now is getting the data. They're already doing a bunch of audits that we've seen, like preliminary audits to kind of build up that capability. It's just a matter of time.
And as far as the law is concerned, everyone talks about this 7-year mark. I mean, but what's the distinction there between your responsibility as an individual to keep records for a period of time versus the ATO's capacity to go back and look at your records over a period of time?
Yeah, when it comes to tax fraud, there's not really a statute of limitation. It's kind of like murder. It's like they can get you anytime. Like there's these rules, right, which really, it's very favourable to the ATO. So the idea of like, oh, they haven't asked me yet, so they haven't asked me for like 7 years or whatever, so I'm in the clear. That's just not true. You can get a door knock at any point in time, and there's a very high burden on you to be able to substantiate your case.
Okay, makes sense. So moving along then, heading into end of financial year, what are the top red flags that the ATO is looking for regarding crypto transactions?
I mean, the first one is obviously if you've done any transactions on a local exchange, that would be a clear signal that the ATO gets as to, are you declaring that activity? To be honest, when it comes specifically to crypto, they don't give out a lot of indications as to what the red flags are going to be. I would say the reality is at the moment, it's really looking at what's being reported by back to the ATO through different processes, and then the individual and does that match up. You'll probably find that the accountant, if you work with an accountant, can already see in a lot of circumstances that you might be an active user based on the information that the ATO sends back to the accountant. So at the end of the day, I think it's just a matter of really having all your books in place versus trying to second guess what the ATO is going to be looking for.
Gotcha. There's a lot of talk in crypto of people making trades around this time of year. So my question is, what constitutes wash trading in the eyes of the ATO? And what behaviour could put investors at risk? Not suggesting, of course, anyone goes out and does this, but...
Yeah. You see a lot of, I suppose, misinformation online. There's this idea of this 30-day window of buying and selling, and then have you truly disposed it or not? If you buy it back after 30 days, you're in the clear. That's actually like a very US-based rule for securities. And so, of course, on something like Reddit, you don't distinguish between US rules and Australia rules so much. In Australia, it's a bit more vague. It's much more beneficial to the ATO. I'm not a tax lawyer and always seek your own advice, but basically the general vibe is, did you truly dispose of this asset for the purposes of actually disposing of the asset, or did you dispose it for tax purposes with the inclination to buy it back at a later date? Yes or no? And they don't give you a specific window for that. So if you're like, well, I sold my Bitcoin today because it's at a loss, and secretly I'm planning to buy it back in a few more months, and hopefully no one notices. In the eyes of the ATO, that's not really good enough. Now, how do you prove that one way or the other is kind of like not very clear.
You could just be trading it because you think it's going to go down and you want to buy it back at a lower price.
Yeah, and you could. And so it becomes a lot more grey, essentially. I think that there are some common things which I don't think are great, which is like I've heard some people like they'll sell all of their assets at the end of the financial year because they don't really want to work through the correct calculations or whatever and the record keeping. So they'll just be like, I'll sell everything and then buy it all back at the beginning of the next year. And every time the difference is like how much I made or lost, and that's a really brute way of working out your gains or losses. But the fact that you're selling everything and buying it back straight after the turn of the financial year kind of indicates that, no, this is not really a genuine disposal of the asset. So this idea of, are you genuinely disposing of the asset, or are you kind of doing this for tax purposes is the big question.
Gotcha. Makes sense. Okay, so for the average crypto investor or a trader, there has been a budget for them, assuming they have, or potentially if they've not made themselves aware of some of those changes. Are you able to outline some of the main changes in this year's budget that they should be thinking of?
Yeah, it's quite interesting, the level of complexity that's being introduced by these budget changes. everyone's probably heard of it by now. This idea of the 50% CGT discount going away, and now, this idea of indexation, which is a much more complicated way of trying to work out what your tax is. It tracks inflation year on year. Your cost basis is going to go up based on the inflation. The implications are kind of interesting from a portfolio management point of view. Like it's, if you hold onto your losers, or even the ones that aren't beating the inflation index, that can really eat into your gain, because the ones that do win are going to be like, the ones copping the most tax, basically. And so like thinking about actively managing your portfolio is going to become increasingly important. And then you've got all these things like these grandfather rules, where it's like the transition from the old system to the new system, being able to value the assets at the changeover date, mid next year, having it's going to be a nightmare. So, kind of, if you were doing it in an Excel sheet or by hand or whatever, it's going to be worse if you already thought it was bad. So yeah, I mean, that's what the engineers spend a lot of time building, is like, these kind of systems, so that it's much more easier to calculate.
Gotcha. Do you think these new CGT changes will have much of an impact on investor behaviour?
I mean, potentially. Like, I do think for, you've heard these things like it's going to be more favourable for people just buying ETFs, because you kind of like, the gain or loss is distributed behind the ETF, and then you're just getting a general indexation of the market, and you just hold on to that. If it beats inflation, then you're not holding on to any losers without knowing about it. That's kind of like an accessible approach to optimizing your gains in comparison to tax. Otherwise, you have to be much more active in terms of cutting your losses. So I think, there's going to be more and more need for like more sophisticated tooling, which we're building around trying to understand what your real gain is in comparison to inflation. And that's going to be, it's going to require more sophistication to actually beat the market through picking and choosing assets, if you're considering your after-tax returns.
Yeah, interesting. It's really interesting. Do you think, people, for example, who've held Bitcoin or long-term hodlers, do you think there'll be an incentive for them to change their positions around the July 2027 deadline, with Bitcoin, given where it is at the moment?
I mean, it definitely could. It's certainly like, a change of the rules. With any change of the rules, you need to reassess your positions. I know I certainly have been. I think it could influence quite a lot of behaviour. Especially, if you are sitting on really large gains at the moment, maybe it makes sense. You got to do the maths. You got to do a few different scenarios. Everyone's different. Everyone's in a different circumstance. But I think it'd be unwise to think that, if the rules have completely changed, is the same strategy the right strategy? And it depends on so many things. At the end of the day, though, like, you can think a lot about tax and your post-tax proceeds, but also, like, if you have strong conviction and you think there's going to be massive gains, and that's your thesis, well, then massive gains are massive gains. Like, it's a nice thing to have the tax bill if you've got massive gains. The bad thing, and what we see is, you have a really big tax bill and not many gains. That can be not so great.
But yeah, what circumstances would that arise in? Can you outline?
I mean, we've seen it in the past where people get themselves into pickles, like you might earn a lot of income from staking rewards, which is taxed at the point of receipt. Like, as you get the staking rewards, they're taxable as income. And then the whole token price collapses. which is like a capital loss, and you're sitting on this massive tax bill and you've got no more assets to pay for that tax bill because, of course, you received the staking rewards. You weren't putting the income tax aside. You just kept it in the crypto, which then tanked. And so we see this a lot, and you could probably... getting yourself into more, you're probably getting yourself into even more pickles now with the complications around indexation and things like this.
I've heard of one horror case was someone who made a lot of money meme coin trading, and then they sold the meme coins at a huge valuation, made a huge tax, got themselves a huge tax liability, and then lost the underlying funds. Through effectively getting scammed, which is a really sad kind of, but they still had to have the tax liability, but without any assets to actually pay the liability. Which seems really unfair, but if you say, oh, look, I'm a freelancer and I earn a lot of income, like say you make 200 grand freelancing and you're meant to put aside tax for that, like, because it's income, and then you go and speculate it on like a meme coin and lose everything before paying the tax bill. Because you could just go to the casino as well, like put it all on black, right? Like if you don't win, you still got the tax bill, and so just this idea, like people rarely in crypto would put aside what's required for tax. Most of the time, they load that up into the market and continue loading into the market, which I fully understand. I mean, I do this often myself, but like you are taking a risk. You're essentially betting with the money that you owe. Whereas pay as you go, it's taken out of your salary straight away before it even hits your bank account. So individuals might not even think about this dynamic. But you can imagine if they didn't, right? Imagine if you just earn your salary and you don't have pay as you go taken out of your bank account. You just have it all. Like how many people would accidentally spend it all and then have the tax bill at the end of the year? Yeah, totally. Massively sad. Keeping on with the theme of tax incentives, I mean, a lot of this budget was around making changes, I guess, funneling incentives towards new property building. But with for example, property, which has been a huge part of, I guess, the regular Australians' portfolios, becoming far less attractive, losing the tax CGT benefit on existing properties, but also the negative gearing benefit of it. How much of that do you think that those tax changes would change the incentives towards things like crypto as opposed to new investments in property, for example?
I'm sure it will have an impact. I think tax incentives for some reason really do skew behaviour, in my belief. I think there's this tried and tested way to get wealthy, which was, get a higher salary, buy a few investment properties, become the greedy landlord. Like, that's fine. That's worked for a lot of people, but it's kind of like not really taking that much risk, and it's not very innovative. Like, it's not, in my opinion, it's I mean, by definition, it's tried and tested. Whereas now, I think the incentives are much more, if I want to get ahead, which a lot of people in crypto are like, they get into crypto
to get ahead.
To get ahead. Like, they're kind of like, how else am I going to get out of my situation type of thing. I think you need to really think more actively about, how you can beat the market or beat what other people are doing, or produce something, like build something, or whether that's new property, or I think they've got some discounts now for new businesses, like build a business, or if you're looking for outsized return, maybe crypto is a vehicle for that, growth stocks, like things like this. You're going to have to become a lot more active to try to get ahead. And
how much of that do you think incentivizes people just to do with the tax now? As an entrepreneur yourself, not having that CGT discount on your own holdings, for example, in the business that you're trying to build, if you're really trying to get a business that's big and large, what incentives just in generally would there be to continue to build in Australia versus, say, going offshore?
Yeah. I definitely get the point. Like, personally, I think it's a little bit overdone. Well, first of all, super easy to just go offshore. Like often you have a lot of family ties or friends and family. You might know this market a lot better than an offshore market. And it's often a lot easier to sell into, say, the Australian market if you're domiciled in Australia versus like moving overseas and then trying to sell into Australia. Like there's a lot of trust there. So I think at the end of the day, like the reality is people who start a business for lots of different reasons, but tax purposes is probably a bad reason to start the business. Like you got to believe in the business. You've got to care. Like you've got to have a lot more conviction to get through the tough times than like what's the right tax domicile. It could be a factor, and I'm sure it will be in certain circumstances, but personally I don't think it's as big a deal as it's made out to be. I mean, there's been some changes, fortunately, which makes it beneficial from a tax point of view, you know, the 10 mil turnover now and stuff like this. Yeah, I just think at the end of the day, you're trying to be an entrepreneur or whatever. Like you want to try to grow the business as much as you can. You want to offer as much value. You might sell the business in like 10 or 20 years. Like it's so far down the track. It's a little bit like super. Like the idea is to grow. The more you grow, the more it's going to be worth. So yeah, I'd focus on that.
Okay. All right, let's get back onto a little bit about the impacts of AI on your business. I asked you a little bit about, you mentioned that AI is helping you reshape. In particular, I think you said that, you know, it's helping the output and it's helping the customer interface. Do you think there's, so what other ways do you think AI is genuinely helping crypto investors with tax and accounting? And where does it probably still fall short, or what would you like to see happen to get further benefits for investors and consumers?
I think, I mean, in terms of building better software, like AI is pretty incredible for that, and it's getting better every day. What we can do now compared to what we could do is wild. And, you know, with it comes like a massive mind shift for most ICs of like, you know, doing the work themselves versus like building a system that does the work. Yep. And that transition, I think people are still going through. Like we've really seen a technological unlock, I suppose, only since arguably, you know, maybe December, maybe January, February, depending on what Opus model you think unlocked it. And I think that's even changing now with things like Fable from the last few days, when we did get it for a little bit before it got taken away from us. I think we're going through a huge shift in how you think about building a business and what people actually are doing as their job. You know, I think this to roll that out to the end user and the benefits that they will see is going to take some time. Like there's massive shifts that are happening for us internally in terms of how we approach work. And we're starting to see like some big changes in the product experience and the amount of features we can build. I think that will show up at the end of the day with to the user, like an investor or somebody who's thinking about their tax, etc. It will kind of be a lot easier to move them up the curve from like unsophisticated to a much more sophisticated view of investing with the right tooling and things like this to kind of make it a lot more accessible. And so I think people will be, obviously, you know, they need to want it, they need to look in the first place, but I think when they start to look, the curve of becoming more sophisticated will be a lot easier, much more accessible. You know, where there's a will, there's a way, but you won't need as much will.
Yeah, okay. It sounds like AI is definitely making compliance a lot easier for the average consumer, but do you think it adds potential new risks, like people relying on AI-generated output?
Oh, yeah. Like we're seeing that all the time, you know, like the thing where, I forget the wording, but where AI always says, oh, yeah, that's a really good idea. Yes, sycophantic. And, you know, we see that a lot. You see that in, like, a lot of the legal community will say this. They're like, oh, you know, like they thought they had a really good case. But at the end of the day, the only person who wins is the lawyers. It's kind of like probably the same deal with for investors, it's like, the person who wins is the market maybe. So I do think there's a level of that of, getting caught in a rabbit hole and then it feeding back exactly what you want to hear. That's where I think like the tooling, like this kind of like more factual, informational view, and having, the LLM or whatever, like these foundational models are just the intelligence, but having the harness around it so that it's like clearer guardrails for the user to get the most out of that intelligence, versus just pairing what could potentially be an unsophisticated view with a whole lot of raw intelligence. There's a path to being able to harness that, which your everyday investor might not, that could almost be a full-time job, or many people's full-time job. So how do you get that intelligence and apply that to the investors I think that's in itself a whole industry.
Interesting. All right, a little bit about the partnership that Independent Reserve has with Summ. You would like to tell us a story about how the partnership came about?
Oh, definitely. Yeah, I mean, I think, we've been talking about it for some time.
That's the question, but I know how this one came around.
Yeah. At the end of the day, Independent Reserve, Australian platform, and we're Australian-based tax software. No better partnership, right, to help solve people's problems when it comes to tax. You could go straight into Independent Reserve, do all your trading activity. You literally just click a button and it ports all that information over to Summ, and we can easily generate the reports. Like, very frictionless. Spend a lot of time in the local market, can cover off a lot of different cases because there's quite a lot of nuances when it comes to Australian trading. Just a partnership that made sense.
Mm-hmm. I think the little bit of extra colour on that, I know that before we had an integration with Summ for our user base, we did have our own tax calculator that we had partnership with KPMG actually previously, and it was I guess that particular tax calculator that we had was somewhat sort of limited, and it only really worked on calculations that were happening on the exchange, whereas I guess once I guess we realised, but also KPMG was no longer going to provide the updates to that software, we kind of had to reach out. So I think in reality I just reached out to you guys and said, hey, we need a partnership. But the value of that was in that you guys have an integration that feeds in all the crypto, not just what happens on the exchange.
Well, that's it. And Independent Reserve, I mean, you guys have done a really good job of noticing this pain point and trying to provide something to your users, well before most people in the market, in terms of like, here's a report you can count on. But to your point, you've got the ability to provide that for Independent Reserve data, but so often users are trading crypto all over the place and moving it in and out of Independent Reserve. And how can you be expected to be able to support all of that stuff? It's just not. It's not what they're paying you to do even.
That's right.
So, but Independent Reserve's definitely been ahead of the mark in terms of recognising this problem. Like, it's surprising how many brokers kind of like will take the commission fees and, service these customers, and it comes to the end of the financial year and they kind of like brush their hands. You see this a lot with DeFi platforms as well, and like so many people come to us and go, oh, look, I had such a bad experience with the tax side of things. I'm never going to use that platform again. And so I think you guys have really been ahead of the curve with that. So,
well, that's what we liked about particularly Summ. I guess when we originally did the integration, it was CTC, but now it's Summ. And because the recognition that the exchanges are really just the bridge into the world of crypto.
Yeah.
And everything else, it's like another world, right?
Yeah.
And so Summ was, again, to you guys' credit, realised that actually someone needs to map out the Wild West and bring it into, as you mentioned before, a standard kind of reporting tax framework that you can deliver at the end of the year and as proof and evidence that you've done in your tax return, you've done what you've said you've done.
Yeah. And you can see everything in the one place. Like, it's surprising how many people are like, oh, I didn't even realise I had this like $100 of crypto still in that wallet. Or like, you could start to see insights as to what activity actually led to what gains, and where did you lose all that money? Like, where did it go? So yeah, it helps a lot to have it in one place.
Maybe outline what it looks like, what that seamless experience kind of looks like from a user perspective.
Yeah, so if you sign up within Independent Reserve, you'll find the menu option to get into the tax report. You click through to that, and it'll, you have to go through a couple of approvals, etc., and then you'll port very quickly all of your data from Independent Reserve. Once you get into Summ, from there, we'll be able to point out things that you've already started to interact with from the Independent Reserve data. So if you've started to send it, to a wallet, for example, things like this, we'll start to have suggestions of like, hey, it looks like you've interacted with these things. Like, do you want to start importing them? It's very important that you do that. Like, if they are yours, that you do that. Otherwise, you mark them as like, no, that's not mine, and it's a disposal, and what's the reason, this type of thing. Once you've connected all of your accounts in Summ, that's when we could start to produce a report based on your full activity, because at the end of the day, you might have bought it on Independent Reserve, and then maybe you put it into a self-hosted wallet for a while, and then you maybe swapped it on like a meme coin platform, and then back and forth, and then you've sent it back to Independent Reserve. So to be able to work out that cost basis, you kind of need the trace of the asset through all of these different platforms. And yeah, really it's about just connecting everything, and then we'll ask you a few questions as you go through it. Maybe there's some categorization and some like if you sent money to a friend, you might have to explain this type of thing, and then you get your report at the end of the day. You can have it either if you're filing individually, we've got the ATO MyGov report, or if you're filing through an accountant, we've got the accountant pack. If you're a high frequency trader, there's the trading stock reports, all this type of stuff.
And I hear you guys are expanding beyond just straight crypto. You're also looking at doing equities and potentially some other asset classes as well.
Yeah, so what we found is, particularly over the last year, is the idea of crypto being another asset class. You're seeing that arise with crypto being in ETFs and things like this. It's gone more mainstream. So there are still people who only invest in crypto, like maybe they're like fully into meme coin trading or DeFi, like they've got some niche and that's what they do, and full respect to that. But there's just a wider set of people who are like growth investors and trying to get ahead. And we've always been really thinking about ultimately those people who are just trying to get ahead and chasing returns, beating the market as an active investor. And increasingly that's between both crypto, equities, and maybe other platforms like prediction markets, things like this. With the CGT changes, we've really sped up our roadmap for equities support in Australia, because we think everyone's going to have a nightmare when it comes to taxes, whether regardless of the asset. And so getting that data all in the one platform, and then being able to generate a report that you can farm off to your accountant or put into MyGov.
So from the engineering perspective, you guys have built your software kind of looks at all the on-chain data, which you guys' on-chain data by definition is really accessible and public and all that kind of stuff. What's going to be the challenges for getting data for equities platforms, for example?
Yeah, it's a little bit different. It's interesting because if you look at DeFi platforms and innovation in that space, it's really like financial experimentation on steroids. So anything you could ever dream of has probably been done in DeFi. And so when you pair that back to equities, equities is a bit more traditional, right? Like there's all these different types of corporate actions, but they've largely been there for a long time. It turned out when we actually looked at this system that the requirements, like it's actually really easy for us to port our existing tax engine over to equities and be able to support all the nuances that those that equities has, particularly around corporate actions and things like this, like share splits, stock splits, buybacks, all this type of stuff. So we were quite fortunate where it's easy to bridge from crypto to equities. I think there are platforms out there that have been focused on equities for a while, and they're going to find it very hard to bridge into crypto. Like that's the hill to climb.
So it's easy to think for you guys being crypto native to kind of go back to the TradFi as opposed to the other way around?
Yeah, it's like a breath of fresh air. You've got like, really accessible data sources which are consistent, which is surprisingly hard to find in crypto. Like what would you expect, right? Like it's a new technology. The infrastructure is still emerging. Whereas in equities, that was the case. And you've got really clearly defined rules, whereas in crypto, there's still a lot
Sounds nice and easy for
great.
you.
It was a walk in the park, yeah.
Well, there you go. So you've got a bit of expertise because you've done the hard stuff first, so now you can go back to the easy stuff, ironically, which is the stuff that's been around forever.
Yeah, well, we have this asset, which is this really complicated tax engine, which works not just in Australia, it works across markets, like internationally. And so that's taken a lot of work to build up with some really weird edge cases as a result of trying to cover DeFi. And so, that's quite durable. And being able to plug equities into that was, it's obviously work, but it's very, very accessible for us, as well as other assets. Like that's fine. It's still to our roots. Like we want to be the best place to be able to support, if you're a crypto trader, like regardless of what you're doing, but if it's very complicated, you could still be supported with our platform, and we can follow you on your journey as you invest and get ahead in life. That's really important for us.
Thinking of examples like Hyperliquid, for example, we touched on at the beginning how certain platforms now, the crypto piece of the activity is incidental to overall activity. Hyperliquid being the best example. Probably fair to say Hyperliquid has been a huge success and definitely made a lot of people, particularly even in TradFi world, look up and go, hang on, there's a new way to use rails of which we can build our business on, which can scale, hyperscale.
Yeah.
From now your experience of having a look at how that system works, understanding the tax challenges with that versus, say, the traditional markets and world, looking at the New York Stock Exchange or something like that, how would you sort of measure up both systems and how would you place your bets on which way, the market infrastructure will go in the future, if that makes sense? Like which one is it easier to build into, I should say, from a tax compliance point of view, but just a market sort of, oversight point of view?
Yeah. I think like these more traditional exchanges, they're built on these systems that have been around for 20, 30.
Exactly.
Forever, right? And there's a certain debt that comes with that. It's well trusted and established and known, but it's hard to do anything new with this. And I think crypto comes along, it's almost like your V2 of all those legacy infrastructures. And it's just that technology is kind of increasingly legacy. And then there's going to be these new rails and new infrastructure that leverages cryptography to secure the assets. And there's less need for middlemen, less need for... there'll still be regulation and scrutiny, but you can start to put more trust in the code itself versus people doing the right thing. I think that's the core essence, for me at least, of what crypto is. It's code is not law. I don't fall into that camp. But this idea that you could start to load up more trust on the system itself versus checks and balances of people and their behaviour.
Interesting. Yeah, that's a really fascinating question. I didn't phrase that question particularly well, but you answered it exactly as if I had asked the question correctly. Yeah. No, fascinating. And so, just because I'm fascinated because you have an insight into, a technical understanding of both of those worlds. And I guess I'm just interested to know which way you think the market will move more to in the future. And based on, I guess, investor preferences and the tax bills that people are coming through, what kind of split are you finding? Perhaps it's not a great sample because your customer base is largely crypto native people.
Right.
But into the future, do you think the split is going to end up being overall more of a percentage of people's portfolios being traded in maybe traditional assets on blockchain rails?
Yeah.
Do you know what I'm trying to say? Or is it, will the traditional markets continue to dominate?
I think it's a bit like, physical retail stores versus the internet. There's no stopping the progress of technology. There might be regulators that slow it down, or a complete lack of regulation, which we lived in for a while there, which will also slow it down. But different markets won't have those problems, different jurisdictions won't have those problems, and they'll continue to advance, and there'll still be this kind of like grey area of innovation, which is where crypto was really living for so long, right? Because there was no clear regulation. So it lives in this grey area of experimentation, which might have actually been illegal, who knows? But like, you know, the regulators are not necessarily checking there. And from that pool of creativity emerges systems and ideas that get ported over to the traditional markets. I think we're just kind of like in the early innings of a build out of this new financial infrastructure, which is super exciting to me because, you know, the finance industry takes up a lot of energy from the economy. Like a lot of smart people get into finance, you know, to work at banks and work at big exchanges and all this type of stuff. And, you know, if the technology makes that a lot more efficient, you could think from a global perspective, all that brain power, human creativity can go to either advancing that, I suppose, or other things, which are now productive. So I'm kind of, you can see my orientation there. I'm like, get out of finance, get into medicine or something. But but like you kind of, it's just, it's a lot of energy that goes to trying to make sure that other people are doing the right thing, isn't it? Like, so like you get the regulators, you get all these systems, all these checks and balances. It's like there's a lot of stuff there. If you can kind of slowly improve that, then that energy can go elsewhere. And also you get a lot more accessibility, I think, as well. Like you get these 24/7 markets, but then people think, oh, well, there's nothing wrong with our banking system in Australia. Like I can send money straight away. It's like the pay ID, it works, you know. But like, you know, people around the world have serious problems.
But even in Australia, a lot of energy goes into making that system work, the banking system work as well. And it's funny, your comments are very similar to what Joshua Roy from Labrador was saying around the work he's seeing as well, and the work those guys are participating in. For example, he just said that, you know, the technology, once it goes into running better systems and, you know, making things more efficient, meant that the humans could be more free of the rudimentary jobs to move into more higher value creating activities.
They could do better things with it.
Do better things with it. They're basically saying you've got more time to do better things with your time.
Which is what the point of technology is. Like before the computers, you were like doing it on paper, like
washing machines.
You know, like the calculator. Like instead of the calculator, you're doing in maths class. Remember the like you're just doing lines and crosses and stuff. Like, like what? Like, of course, it's better with technology. It's just like, and you get this backlash right now with the AI. It's like, oh, AI is going to put us all out of jobs, and that's always been the case. Is this perspective of like, well, change is bad type of perspective, and I just think there's no end to what humans want or could do in their creativity, and as soon as the system or the computer or whatever is doing a job, there'll be something else that humans come along and go, well, actually now we want this, or we could be doing that instead, and they'll start to, and there's just always something more. And you know, if it wasn't for technology, like where would people be from like a health perspective, from I don't know about you, but I don't really want to go back to the bushland, and I love camping, but to just do that full time, that's not my thing. Like you need the technology to get you out of that.
I totally agree. It's funny. I know Josh made a comment along the lines of he doesn't ask for updates from his developers now. He just gets his AI to talk to their AIs about their status of how they're working on things. Yeah. To keep the humans from context switching and just have them more productive and engaging in things that add more value. Yeah,
I still like talking to the people.
Well, you and Matthew have to compare facial hair, you know, for various points to make sure beards are on track.
Yeah. No, honestly, like I think that way of working with AI is still emerging. I think there's a lot of space for humans. At the end of the day, it's like a human economy. The AI is not. I mean, there is cases where the AI is buying stuff, but most of the time, we're buying stuff off each other and trading value. Like it's a human world that we live in. It's a human experience. So long as we're still here, it's going to be a human economy, and humans need to be in there. Like it's not going to.
It's good. No, I guess I just want to touch on that. A lot of people focus on AI is taking our jobs, but no, it's technology. It's taking away stuff we shouldn't have been doing anyway, because that's why we have technology to take away these things.
Yeah.
Nobody wants to go back to hand washing clothes by them, for example.
Yeah, I think the real problem is when you're like, oh, look, we've got a laundry machine now, so you don't need to hand wash the clothes anymore. And then the real problem is when you get that person is like, yeah, but I was good with washing the clothes by hand. I was happy with the $16 an hour, whatever I was earning, washing the clothes by hand. And now you're taking that away from me. I'm going to have to think about what I'm going to do next and like maybe retrain or skill up and do something else.
Good point.
And it's like, but I personally don't have a lot of time for that. Like, yeah, you're not going to get paid to do that thing anymore, and it's going to be some structural changes for people, but it's more exciting that you could do some other stuff as a result.
Approaching life like an engineer, Shane.
Well, yeah, some common sense maybe, but yeah, you gotta grow, right? It's the growth mindset versus no, we like it as is and we don't want anything to change.
No, I like it. Yep. All right, we've run through the questions.
Nice one. Thanks so much.
Get out of here now. No,
yeah.
No, it's not that. Hopefully, we got through all our questions, and I don't think that. And we've got some extra ones in there as well. I mean, we could cut some more questions if you guys are interested in. Yeah, perfect. That was awesome.
Nice one.
Shane, classic Shane. Like, I love this. Like, every time I ask a question, try and make a little bit of not a snide comment, like a cheeky comment, and like you've got the engineer approach to it, going, no, it's not. I'm not. Sorry, it was just funny to listen to, because I was like, it's great when I hear you talk about stuff like that, and Josh was the same. Kind of approach stuff like an engineer, and you just be like, well, here's a problem. I need to think about it. I use my brain to solve things, right?
Yeah.
I was not trying to have a go or anything. I was just trying to. I was trying to figure out the funny. That's what I meant by you're like, how about some common sense?
Yeah.
No, I like that.
I get it. Like I think structural unemployment is the fear, right? And it's definitely a point of contention. I can relate to it. Like, it's super scary about what comes next. I think you just like got to get ahead of it. I don't know if we're still on record.
It doesn't matter. We can edit it or whatever.
Yeah.
I was just talking more generally because I find that interesting.
Yeah. It's definitely a thing though, right? Like, people are like, oh no. I don't know.
People don't like change.
I mean, you've seen like with coding, like so much of it's changed, like how you work and how much you could trust the AI. Like, there's such a debate going on at the moment. It's anyway. People don't like change. Yeah.
People don't like change.
Get comfortable. Right?
Oh well, I like change. It's good to see. And the AI stuff is just phenomenal. I can't understand why anyone wouldn't be just applying it to everything they do to make their lives. And it's just freed up so much manual labour.
Yeah.
And even in the office, you don't think of manual labour because you think of manual labour being putting up scaffolding or something. But like processing data and spreadsheets and reporting and all that kind of stuff, it's work. Like the amount of manual spreadsheeting that even the accounting team does could be like, Claude, do this for me now.
Yeah.
And you can think more about, okay, conceptually, what should I be doing to make this business better? And what are the things? How do I engage with the humans to get better outcomes? And take the business in a more productive direction. All this kind of stuff that only a human could do.
Yeah, all those mouse clickers and keyboard things. That's all manual labour.
The new blue collar worker of the 21st century is the office paper pusher. Right.
Yeah.
They're doing manual labour because there's someone there going, okay, we haven't got a human an AI bot to kind of go, let's collate this data and let's put these spreadsheets together, gather this information here, gather this information there. You can automate all that stuff now. And my reporting that I use now for Claude if you get an Excel spreadsheet and your sales pipeline data and go match it all up. That was it wasn't necessarily the worst job in the world, but it would take you 2-3 hours a week. Now it takes 30 seconds. Like, times those little incremental advantages through your week, and all of a sudden you've got like an extra 10 hours in your week. Manual clicking. For want of a better term.
Yeah, I like the paper pushing thing. It's like with the AI, you realize how much was paper pushing. Right. And it's kind of like that kind of maybe was manual labor. It was pretty repetitive. And you didn't really realize at the time until you see the technology. You're like, oh.
You just weren't, you were just doing the bits yourself, or those kind of pointless work because you're just kind of attaching documents and gathering, copying, pasting, whatever.
Yeah.
Same as digging a ditch and linking
A
up channels.
whole lot of routing kind of. Yeah.
Yeah, interesting. All right. Well, thanks, Shane.
Nice
We've done our hour. We got through our questions. We've got some great content, and thanks you for the stuff. You know what we thought, with some of the ATO questions, because we're going to do some talk with some other guys in tax as well, and we're thinking, well, Shane's more of an engineer than he is an accountant. But
Yeah.
I think it was just interesting to see your take on all that kind of stuff.
Yeah. You get the accountant's view, and it'll give you the black and white kind of thing. I think it's just the mindset thing of like how to approach the taxes is like, like sell it if you genuinely want to dispose of the asset. Don't do it because you think it's going to be a great tax benefit and you hope to get it. Like any of that, like, oh, I'm going to get one up on the ATO. It's kind of like, that's probably what you don't want to do.
Yeah. But totally.
Yeah.
Well,
Thanks,
thank you for coming again, Shane. This is the second time we've had you on, but I guess we'll see you for a third time in the not too distant future.
Yeah. Really appreciate having me on. Always good. Independent Reserve as a host. A beautiful podcast studio. So thank you.